Oh wow, Tesla just keeps going up. Time to get in at this little pullback. Oh my god. When a stock starts to look like an Olympic ski jump, it's probably safe to assume that the move might be over and that we probably missed our chance to get in. But, of course, it was tempting to give in and just jump in after it just kept going up for weeks. This thing beat its all-time high and then kept going another 50%. Now, this was a long-term example, but this obviously happens in trading too. Price is on a strong move up, and instead of waiting for a pullback or for a new setup, we jump right in for the fear of missing out. We all relate to that and understand that, so I'll try to teach you some things that you might not know, and then let's look at how we can solve this problem. Hopefully I can change your perspective. Have you ever had your hands start shaking while trading? Or is that just me? Well, for some reason, this idiot of a brain that lives in my head thinks that the chart is a threat and that we need to either fight it or run away. Part of what makes us nervous is because we perceive price action as a threat. It doesn't make sense, but for some reason, when I buy a contract on ES, my brain thinks we're about to fight a bunch of bears. This fear is not quite the same as the fear of missing out, or FOMO, but it's similar. In real life, most people experience FOMO when they think they're missing out on some social gathering, trip, or some experience that other people are having without them. Personally, I experience the fear of missing out when I'm at a party and I'm afraid that I'm missing out on having fun with my computer. First, let's just go over some basic logic with day trading. Obviously, there will be some exceptions to what I'm about to say. But if we are supposed to think in terms of probability, then we have to be thinking about always going with the move with the highest probability of success. 1. The majority of all moves are not big. 2. Therefore, we should not jump into a trade in the same direction as a big move. 3. This is because the bigger the move, the more likely it becomes that it will end. Remember, we're thinking in terms of probabilities, not in terms of what we feel like is going to happen. Feeling like something is true does not make it true. We have to do what the math says to do. The farther a move goes up or down, the less likely it becomes that it will continue. For the most part, large moves are very unlikely. Now, let's talk about a situation that everyone can relate to. You have a clear plan when if the price gets to a certain point, you are going to go long. So, the price moves up, but instead of reaching your buy order, it just barely misses it and starts climbing up without you. What do? The frustration of missing out on money and not being rewarded for correctly predicting the price going back up makes you jump in. Of course, this is what happens. Look at this picture. No? Fine, you don't have to, but it would probably help. You like that one?
Yes, I was trying not to laugh.
These are 2-minute candles. Pay attention to the height on each one. For the most part, most of the candles average around a size similar to this blue rectangle. Now, time for more logic. If a red candle is this long, and if the price is at the bottom, then the probability of it moving further down is less likely than the probability of it moving back up. Ignore the fact that the next candle might move down further. What I'm saying is that the longer a candle gets, then the less likely it is that it will continue to move in the same direction. We know this because of the average length of each candle during any time frame. Each time frame has their own average-sized candles. It's pretty easy to see when we might be entering a trade because of FOMO if we are entering into a same direction trade on an extended candle, or even if the candle is just the average size. The greatest entries we can achieve will be on what is currently a small candle, because it implies that by the time the candle is finished being formed based on the chart type, there's a higher probability that it will be a few points away from its origin. Obviously, this would be a tough trading strategy on its own, and it would be better for a computer algorithm, but I hope I was able to communicate the way I think to you. Look at this candle. It's huge. Using our knowledge of the average candle size for this particular time of day, which was during the afternoon, we know that a move like this is an outlier. Whatever it is that you trade, look at how big each time frame candle usually is. You know that you are only getting in because of FOMO if you went long at this candle. And what always happens when you get in just because of how painful it was to see what could have been a huge winner? That's right, it went the opposite way. This was just one way that you can check yourself before making a FOMO trade. Another way is a bit harsher, but some people need to hear it. I need to hear it too. If you can't respect your rules, what are you doing? As traders, all we have is a plan, and all that we have to do is to follow that plan. Obviously, that's harder said than done. But I'm sure there are people like me out there that find it more useful to have the harsh truth than to be told of a few techniques that can certainly help, but they don't really address the core problem. The fundamental problem to FOMO trading is not respecting our rules and staying disciplined. Respecting our rules is the simple but difficult solution. If you're like me and struggle with this, for some people it can be as simple as looking at a piece of paper every couple of minutes with helpful notes on it. Don't trade in the same direction as a large candle. Don't take a trade with less than 2 minutes of planning. This one can be adjusted for each person, but this helps stop impulsive as well as FOMO trades. For the most part, the really good traders that I've watched had a plan for several minutes before they initiated a position. Matt from Day Trader Next Door has his stop loss, profit-taking level, and entry price planned several minutes before he starts his positions. And remember, each trade is not as important as the sum of all trades. We put too much emphasis on each individual trade, but we need to have a broader perspective. Mark Douglas from my first video talked about how we need to broaden our perspective and to not think about each individual trade. Part of that is because we need lots of trades to determine the worth of a system, but it's also because this perspective reduces the emotional involvement in each individual trade. This is important to remind ourselves, because missing out on one trade is not the end of the world. Every day, there are stocks that go 30, 40, and 50% up in a single day. Hypothetically, you could turn $1,000 into more than $1 million in just 10 trading days if you could pick these stocks before they moved up 50%. Every single day, we miss out on life-changing amounts of money to be made, but we aren't thinking to ourselves, oh man, I should have sold my car and put that money into this sketchy startup pharmaceutical company yesterday. We can't get them all, and there will always be another setup. So, it barely missed our order price before going up? Big deal. We're in this for the long run, not for just 2 days to make as much money as possible. In 20 minutes, there might be another setup. Even if there's no setup for the rest of the day, that's okay, because tomorrow there might be 3 more. Another thing that we can ask ourselves to try and take a more rational approach is, would I take this trade 100 times? Think about real-life examples so this makes more sense. I play disc golf, and there are many different shots I can throw. However, I always go with the shot that has the highest probability of working. This is no different than trading. If we always take the highest probability decision, then the math will do all of the work for us. Now, trading isn't this simple, but the concept of probabilities is. It makes more sense to always go with the 80% chance than to try and guess which times the 40% chance will be correct. Remember, the longer a candle or move is, the less likely it is to continue. If you can nail that into your head, it should help with resisting the urge to jump into something extended. If we can't get in early, don't get in at all. Sometimes we just have to deal with the feeling of being wronged by the market when it barely misses our entry and leaves us in the dust. When you feel out of a relaxed mental state, take a look at your notes and try to bring yourself back together. I teach this stuff, and I'm not able to do what I teach without the help of notes. I have lots of problems, so I have lots of notes. These are not easy things to do. Forcing yourself to wait a minute or two before entering a trade can give you enough time to realize that you might just want to get in because of FOMO, and it can also reduce impulsive trades. If we can't respect our rules, we can't make it. The only thing separating us from a toddler with a buy and sell button is rules. Well, maybe a little more than that, but I think you get my point. I can say a bunch of ways to deal with these problems, but if we don't actually implement them, then we won't change. We are the writers of our destiny, and we are the ones who decide whether or not we will be successful. I know I can do it, and I know you can too. If I've earned your subscription, I would appreciate it very much. Have a good day and night, and ask questions if I wasn't clear enough about something here. I know what I mean, but that doesn't mean it was clearly communicated to you. So give me the chance to try and reword it if I didn't make it clear.